are live.
All
So
right.
hello, everybody. We got people trickling into the room here. What's up, Bill, Bob, Bruce? Thanks for joining us here today. And got a lot of familiar names here. So we're going to give it a couple minutes here as we kind of get things started to make sure everybody jumps on the call. So it's an interesting time in the markets right now. It's a great opportunity for us to answer some questions and address some concerns and kind of share our thoughts around the market and where we see things today, where we're headed in the future. And that's what we're here to do. We started doing these a couple of years ago, and our aim is to continue to provide you quarterly market outlook commentary such as this on an ongoing basis.
Right.
If you don't know, I'm Casey Weade. I'm the president here at Howard Bailey Financial. And we also have our chief investment officer, Marshal Johnson, here as well. This is what we're calling our market outlook. And this is May 2022. In case you're watching this at a later date, this is an opportunity for us to share with you our insights on what's going on in the market, what's happened year to date over the last quarter, and what we're looking at, keeping an eye on over the coming months. This is also an opportunity for us to answer any questions you might have. So if you have any questions about anything that might be going on in the market, maybe you have questions about interest rates or inflation, doing Roth conversions, tax loss harvesting, maybe you have questions about cryptocurrency, whatever it might be, drop them right there in the Q&A. So at the bottom of your screen, your Zoom screen, you'll see a little box that says Q&A. All you have to do is click that button and you can drop your questions right in there, and we'll answer as many of those questions as we can throughout our conversation here. What we're going to be doing is opening up. Marshall is going to walk us through what's happening in the market and the way that we're looking at it, and then we're going to get to Q&A. We're also going to share with you some of the action steps that you might want to think about if you're working with our team, or if you're doing it on your own, or you're working with another firm. This is a great opportunity for you to take away some strategies and implement them into your financial life. And boy, this year has been a bit of a roller coaster ride. And the thing about roller coasters is not
some people don't like
them,
them, right? Yeah. No, that's my son, right? I took him to Cedar Point last summer. Was all excited to show him the roller coasters that I loved as a kid. And maybe I started off just a little too abruptly, but we jumped into one of the big ones right out of the gate. And he pretty much hated it, Casey. And so that could be a lot like the stock market. We've got a lot of new investors coming out of the pandemic. For a long time, it was always, when are millennials going to start to invest? Well, through the COVID pandemic, with the stimulus checks and that extra savings, a lot of millennials jumped headstrong into the market. And this is the first abrupt market sort of volatility roller coaster, if you will, that they've had to endure. And I think we're seeing a lot of negative sentiment. There's a lot of concerns out there. So we just wanted to open it up today and open the conversation and make sure we touch on some things that we're keeping an eye on.
Yeah, I love roller coasters. I don't really enjoy market roller coasters that much, but I understand them. And I think that's what we're here to provide, is a little understanding about what's going on in the market so that we can feel more confident in where we're at today and where we're headed in the future. But my wife's one of those that absolutely hates roller coaster rides, whether it's in the market or whether we're actually at a park. I'm pretty sure I'm the one that's going to be riding those rides with our little kids for years into the future. So let's jump into it. We already have some great questions coming in. So please, again, drop those questions in there. Right there in Q&A. If anything comes up for you throughout the conversation, just drop them in there and we'll answer those once we get to our Q&A segment. So Marshall, let's just kick it off with talking about where we find ourselves today. What's happened this year?
Yeah. So this slide here is just a perfect example of what's kind of going on year to date. There's three different lines on this chart. The orange line is the Bloomberg bond aggregate. So it's kind of an idea of what the corporate bonds are doing. The blue line is what U.S. Treasuries, specifically 20-year Treasuries or longer term government bonds, are doing. And the purple line is good old S&P 500. And you can see from that, I had to pull this data. This is through, I believe, yesterday's close. or the day before. The day before is closed, so down 17% on the S&P. But the markets do go through these gyrations. But I think what's
Yeah.
challenging this year is that those numbers you see in the loss category for bonds. The aggregate bond index is down about 10%. But look at those government treasuries. The 20-year is down over 20%. Now it started to tick up a little bit in the last couple of days, but 20% losses from treasuries. That's something that we haven't quite seen in a long time. Actually, the S&P is off to its worst start in 70 years, 72 years. So since
Mhm.
1950, worst start since 1950. The bond market is challenging previous lows set in 1790. Maybe this was written in the Sanskrits, but apparently that was a bad year for bonds. So this is something that
Over 200 years.
yeah, 200 and
Amazing.
some years ago, you haven't had to deal with the situation that's kind of present so far. Now, keep in
Right.
mind, this is just through the first 3 or 4 months of the year, so we're not talking about the worst years on record or the worst quarters. This is just the start of the year. We're off to a pretty poor start.
Yeah, and what you're saying there, we can say, well, this is, we're off to the worst first quarter of the year, since 1929. Well, that if we would have started this in, say May or June or July, yeah, you may not be able to say that same thing. And I think that takes us back to the media, and they're trying to garner our attention, right? They're trying to gather
Right.
our attention, gather eyeballs in order to sell more ads, and headlines like that tend to terrify people. Fear sells, and
Fear.
that's exactly what they're trying to accomplish. And Marshall, you and I had this conversation here this morning talking about the market. And I said, yeah, I don't understand why some are that concerned. Yeah, and I've got to
Mm-hmm.
say, we've only had a handful of conversations with families that have called in that actually are concerned, because the families we work with have a plan, and this is something that we've been talking about and harping on for years. Really over a decade, we've been talking about the risk
Right.
of rising interest rates. If interest rates go up, you need a strategy for the fixed income portion of your portfolio or the bond side of your portfolio. Because I look at the market this year and go, we're only down 20%. I mean, we're not even in bear market territory with large cap US equities, Dow Jones or
Mm-hmm.
S&P. Why would there be much fear right now when the market hasn't seen nearly what it even saw in March of 2020? And that was a much more fearful time period.
Yeah,
And I,
well, then the numbers stack it up too. We saw on Michael Batnick's blog yesterday that global growth optimism is at new record lows, lower than March of 2020, lower than June of '08, lower than December of 2000. These were some of the worst markets in the last 100 years, and our optimism is at new record lows. So that was the driver
Well,
of our
and when you
conversation,
look at
Casey.
those charts, you and I overlaid, consumer sentiment with,
Hmm.
the history of the market, and it
Right.
tends to be lowest at the bottom of the market. And as low as it is today, it doesn't really line up with what we've seen historically. The S&P would typically be significantly lower with consumer sentiment as low as it is. And where I think we both came to this conclusion, why is that today? Well, it's because, this generation of investors, all the current generations of investors, they haven't invested in a rising interest rate environment where they've seen both stocks and bonds lose value simultaneously.
Right.
And this is why, again, we've harped on having a fixed income alternative. And for us, quite often that is a fixed annuity or a fixed indexed annuity, a vehicle that can produce bond-like returns, get us
Mhm.
3 to 6%. Just don't lose when interest rates
Don't
go
lose
up.
me
Don't lose our
20, yeah,
principal. Yeah.
22%, right?
And this is what can happen. We drove home many examples over the years, from radio to podcast to TV, that it wouldn't take much of a shift in interest rates to see a pretty significant drawdown in the value of the bond market today, treasuries or government bonds or municipal bonds alike. And that's what we're seeing today. I think why we're seeing more fear today, why that consumer sentiment is so low, is that it's those traditional investors that had this 60-40 mix of stocks and bonds who didn't ever expect to see both their risk hedges and their risk on assets inside their
Mhm.
portfolio lose value simultaneously. So again, This is why we want to incorporate alternatives for the bond fund portion of your portfolio, or we want to own individual bonds. So there are some options that you have in order to mitigate that risk. And if you've already implemented that, you're probably not on this call. If you actually listened to our advice, followed our framework, then in large part, then this should be very minimal concern. One, you have a plan for the worst. Two, you have fixed income alternatives built into your portfolio. But I still understand that anybody that's watching the news, anybody that turns on the TV or opens up CNN, they're going to get fed these things. And Marshall, I think your dad's on here, and your dad is one that I don't think has any money in the market,
Right.
and still is paying attention, right?
Yeah, you would think, being my father, he would have a lot of money in the stock market. But when my dad was nearing retirement, we put a plan in place where for the first 10 years, we weren't going to take hardly any market risk. And so for the last 5 years, you could look back and go, well, geez, Dad, you missed out on some upside. But the positive is he doesn't have to worry about, opening up a statement and seeing a 20% loss as well. So for him, that outweighed the potential upside. And really, it's not to say that he's never going to get back into the market. This may be one of those opportunities that I think we can start to move some back to the market. But the long story short is the market is not a necessary tool for every family, right? I think
No.
we've been kind of ingrained in that thought that we have to have a 60-40 or 50-50 mix. Like people that have overfunded their retirement, which a lot of our families that we're blessed to work with, they've saved more than enough for retirement, so they may only need 2 or 3% required rate of returns to make their plans work. At some point, they may say, you know what, I'm done with the roller coaster. Be like my son Grady, and be done with roller coasters for the time being. And it's about understanding yourself, understanding the markets,
Yeah.
realizing, I think to piggyback on your other point, Casey, we talked about why people may be feeling this drawdown that isn't even quite 20% yet. So much is those bond losses. So normally when the market's down 20%, let's say you look at your account value and maybe you're down 9 because your bonds kind of hung in there. But you got to remember that bonds have been, interest rates have been falling for the last almost 40 years. And this long-term bull market for bonds, as interest rates fall, bond prices, existing bonds go up, their market value goes up. Well, as we start to see interest rates rise, then existing bond prices are going to fall. And we just have to understand that dynamic, that's a tectonic shift in the way investors need to look at their portfolios.
Yeah, and this is also why we emphasize keeping some dry powder on the sidelines. I myself, I look at the S&P down 18, and I'm sitting there going, when's it going to get to 20 so I can deploy some more
You're not
capital into the
even.
markets? And I'd like to
Yeah.
do a little bit there. And I think there's still potential for further downside. We get to 30%, I'm going to see that as a great opportunity. And we're seeing this from some of the best investors in the world. The Oracle of Omaha, Warren Buffett. The reason he is where he is it's not that he's just the most amazing investor in the world. He loves a roller coaster, and he's been able to endure these time frames and capture those opportunities when they arise. Berkshire Hathaway deployed more capital in Q1 than they've ever deployed before. And
In a
so
quarter. Yeah.
they're taking advantage of the opportunities. And that's the way that we need to look at this. If we're going to invest in at-risk assets, we have to be prepared for volatility and to look at those times as opportunities as well, and keep some dry powder on the sidelines. So Marshall, let's talk about what this has looked like over time and just how long something like this might continue to happen.
Yeah, so if we take a look at drawdowns, here's a chart that shows drawdowns since 1928. And you have to realize that the stock market does go up over the long term because you endure these losses in the short term. And if you think about it, the stock market has to go down it wouldn't offer such fantastic returns if it didn't, if you didn't have to handle a meltdown from time to time. So this chart shows some of those meltdowns. And when you invest in the stock market, I think a lot of people get caught up in the averages and say, well, you know, the market's going to average 10 to 12 or 10 to 15%, depending on what you're looking at. But you got to realize it doesn't do that every year, year in and year out. And we've just been a little, coddled a little bit the last 12, 13 years. We really haven't had to deal with a lot of volatility in some of these big drawdowns. But that's why you get these combinations of huge gains followed by seemingly bone crushing losses. It has to be this way for the long run returns. They wouldn't exist if we didn't have to go through these drawdowns. So you can see some of these drawdowns were obviously much longer than others. But, Casey, there are some short ones in there as well. March of 2020 was an awful short drawdown.
Yeah, and we talk about this with every family we meet with in our first visit. We're talking about the market and how, because most of the families we work with, they've been saving and investing in the market for a lot of years. They've went through some of these ups and downs, but maybe they didn't feel them because they didn't need those dollars at that time frame. And we explained, yes, the market will average 6 to 10%, but those are 10, 30-year rolling averages over the last 100 plus years. And it doesn't move in a linear fashion. The market is not statically earning 7, 10% per year. It looks a little bit more like this. It is a little bit more of a roller coaster ride, which is why we always emphasize, if you're going to draw income from your portfolio in retirement, you should have a fund someplace where you can go to when the market's down so that you can give yourself some time for your market dollars to recover, or you should be building in some time into your plan where you have a guaranteed income for the first 5, 10, 15 years. You have a chunk of guaranteed income so you can continue to take risk like you did when you were younger. Because again, the market doesn't move in a linear fashion, but if we can buy ourselves some time, we still know that equities are one of the best places over the long term to not just grow our portfolio, but to outpace inflation simultaneously, which is a major concern today.
Yeah, and to piggyback on your point, if you look at the market daily, the market is largely driven by emotion and sentiment on a daily basis. But to your point, it does look a little linear when you start looking at decades, right? You talk about Warren Buffett building his wealth. He didn't have that wealth when he was 40 years old. It's the long term that really drives that wealth, and things do look a little more linear when you zoom out. But if you kind of isolate and look in on these drawdowns, it is going to be driven a lot by sentiment in the short term.
So let's drill down on interest rates a little bit. And again, some of you just came in after we opened the conversation. If you have any questions that you'd like to get addressed, just drop them right there in the Q&A, which is right there in the lower portion of your Zoom bar.
Yeah, so we started to talk about interest rates. I think everybody understands that we've been in a supremely low interest rate environment after the COVID pandemic. The Fed just dropped everything to the ground, which really helped stimulate the economy, right? If you looked at mortgage rates during 2021, just last year, the average 30-year mortgage rate was 2.91%. I mean, tremendously low interest rates. But what that's done is that's caused inflation, and intentionally, in some part, by the Federal Reserve. They knew that that was going to be an inflationary move, and some are going to say that they overdid it. And the history books will look back. We'll be able to look back one day and really decide whether they overcooked it or not. But at this point, the Fed is now having to reverse course. We saw the first rate increase here in Q1 of 2022. That's the first time they've raised rates since 2018. Some of you may remember that. That was right after an election, and we had two corrections at the end of 2018. One right before the election, and one when the Fed raised interest rates in December of 2018, much to the chagrin of a lot of politicians and those that were kind of wanting the Fed to be more hawkish. And so that was followed by a 50 basis point increase here in May, which is the largest increase that we've seen in 20 years. And it's going to continue. I mean, the Fed has pretty much laid out a very transparent plan where they plan to raise rates over the summer several more times. I mean, you may you may see 4 to 6, potentially 8 additional rate increases over the next 12 months. And that is going to depend on what happens with the inflation rate and what happens with the economy. I think a lot of people misunderstand that. They think the stock market is is driven by the economy, but that's not always correct. The stock decline here most recently is driven by interest rates. First of all, the stock market does not directly reflect the economy. There's a link. But what the stock market tracks is two things: corporate earnings and interest rates. Earnings, of course, grow when the economy grows. So when interest rates are stable, then you're starting to see the market respond in a very similar fashion. So most of the time that we think the market tracks the economy, but we are now in one of those times where interest rates are not steady. They're uncertain. There's a lot of confusion and misunderstanding about how quickly they are going to rise. Over the past couple of months, we have seen a rate increase at some of the fastest paces we've seen in decades. Thus, even the economy has done pretty well. Earnings continue to grow. These high interest rates have acted as a headwind and pulled down the price investors are willing to pay because they see the potential here. If interest rates have to go up sharply, that may lead to a recession. We're pricing in, the market looks like it's pricing in a recession in the next 12 to 18, 24 months, which means corporate earnings are going to be down, which means stock prices should be adjusted.
Well, I think now many feel that it seems like the term recession has become synonymous with depression.
Or crash.
Yeah. And these are massively different things. We regularly go through recessions. We shared a chart recently. Marshall, I don't know if you have that chart, or you can kind of talk through, the history of recessions and kind of what we've seen there and exactly how that's really impacted the market.
Yeah, I don't know if I can pull it up real quick here, but the point is that you're going to go through, hopefully you're going to go through 12 to 16 or 14 recessions over your lifetime. And I think that sounds dramatic, but the hope is that you do have an 80+ year lifespan, and you're going to
look
go
at 2020
through these recessions.
recession, markets up deep double
Yeah,
digits.
yeah.
Right.
So you're going to go through these recessions over a lifetime. They don't always have to be catastrophic. Some are obviously shorter than others. But what the Fed is really hoping to do here is really start to pump the brakes. That's exactly what they're doing. They're trying to avoid having to slam on the brakes, much like we saw the Fed have to do in the late 70s, early 80s, when we had kind of runaway inflation. So the Fed's really trying to get ahead of this. Kind of
They
in the face.
are, but
Yeah.
at the same time, I'm talking to Dr. John Cochran. We released a podcast episode with him recently. Dr. Cochran's one of the most well-recognized economists in the world, professor of finance at Stanford, previously at University of Chicago. This guy knows his stuff. And I kind of jokingly said, boy, they really increase interest rates a whole lot really fast.
Mhm.
Like a half a point. I mean, we're not talking
Right.
about truly significant interest rate increases, which is why many feel that this is something that was an overreaction, and we may see a quicker recovery than some may expect.
Yeah, and I think it's more alluding to what we may see, right? We may see they've taken 75 basis points off the table, but if all of a sudden the Fed has to start driving rates 75 bips at a time, that's going to that's like landing an aircraft, a fighter jet on an aircraft carrier. That's a hard stop. That would be a hard landing. The Fed is hoping for a soft landing.
Yeah, and this all comes down to inflation. So
Mhm.
let's let you kick off kind of some deeper discussion around inflation.
Yeah, so I think all of us can feel the weight of inflation, and this is really what's going to hurt consumer spending. If we look at the 12-month CPI ending at the end of April, the major categories that are comprised of the CPI increases or decreases are shown in the percents here. So inflation, all items, 8.3%. Food, 9.4. All you got to do is go out to eat anywhere these days. It's almost like the prices on the menu should be temporary. You got stickers over certain places.
Well,
Nine
Marshall,
point,
to that point, and one of the things that we've seen is we've seen significant wage increases over the last 12 months, significant
yeah,
wage increases. And what I'm saying there is, let's say that inflation is under control and it is transitory. We know that it is in large part supply driven, so it's supply driven, but it's also Fed driven. But being that we do have such a large factor of being a supply driven inflation, that we've had supply disruptions around the global supply chain.
right,
Yeah,
sure.
that factor in and of itself means we may see inflation get under control sooner rather than later. Maybe this was an overreaction, and all those individuals that got those big wage increases, what's going to happen 12 months, 24 months from now when inflation is under control? They're going to keep those wage increases.
Yeah, they're not going to give them back. I don't think so. We're seeing the same thing with rents as well, rent increases. But here you can see energy is the largest, 30% increase year over year in energy cost, followed by 6.2 on core inflation on all items less food and energy. But the reality is that we're all feeling it. All you got to do is, gas prices are the easiest thing to see because we drive around town, we see them. We know what gas was like when we were a kid. And recently, Georgia was the last remaining state to have less than $4 a gallon oil and or gas, and they recently popped up over $4. So now every state in the country, with some states as high as $6. Our friends out in California.
All right, Marshall, where are we headed?
Where are we headed?
Get
When we
that
talk,
crystal ball out, would you? Tell me
when we
exactly what's
talk,
going to happen.
I really wish the crystal ball was a little clearer. But
Don't
the
we
current
always?
U.S. stock market, we just refer to the S&P here, is down about 18, almost 19%. So we're pushing for that 20% draw. We're not pushing for it, but the market is pushing for a 20% drawdown. That would really be bear market territory. But we go back and we look at the S&P 500, and the average peak to trough drawdown is about 13% since 1950. So you can argue that the drawdown we're seeing right now is above average, right? It feels that way. It's kind of been somewhat quick. Sometimes we call these waterfall drawdowns because the market just kind of waterfalls down really quickly. But going back, we did the research, going back to 1928, so 94 years, in 94 years, 59 of those 94 years, we've seen double-digit drawdowns at some point during the year. Roughly 2/3 of the time, you're going to lose double digits during a current year. However, 60% of the time during those years, you still finish positive at the end of the year with a gain. So even though you experienced a double-digit drawdown, 60% of the time, the market was able to recover or claw back to positive before the end of the year. And surprisingly, even more, 40% of the time, you still finish the year with a double-digit gain.
Mm-hmm.
So the other day, I had a friend asked me, he's like, well, what do you think? Is it going to be a year where we finish down 30%, or, might we have a positive return? And I looked at him and I said, if I'm betting on the odds, I'm going to bet that, hey, the market might be up 4 or 5% before the end of the year. That's what happens the vast majority of the time after we see these sorts of pullbacks.
Yeah. Well, Marshall, the overall economy, pretty strong, right?
The overall economy is fairly strong and did not slow much in the first quarter. That was good. Remember, the market is not the economy. The unemployment rate dipped to 3.6% in March. The total number of unemployed Americans dropped to 6 million as we made it through the latest COVID-19 surge. Companies began working on catching up demand as the supply chain began to repair itself. But some industries are still having a hard time. But at the end of the day, corporate balance sheets look good. I hear a lot of people say this looks like another 2008, or, you scroll on social media for too long, and you'll see somebody overlay this chart over what happened in 2008. And you got to remember, some people are always pessimistic. Some people are pushing that fear button because it drives their own self-interest. But the reality is that corporate balance sheets look really good. Personal balance sheets look really good. Individuals, the largest asset for a lot of families in the United States is their home. What's happened with their home price? What's happened with their equity? Heck, some of these people have seen a 20, 30% increase in their home values over the previous 12 months. So that helps their balance sheet. They're getting raises. They're getting more income. There's 1.9 jobs for every one job seeker, right? So kids coming out of college today, it's like pick of the litter. They can choose where they want to go. The fundamentals are still pretty strong, even in the face of some of the supply chain issues. We still see, chip shortages. We still see lumber prices and material cost of building supplies and things like that still way up, and that's creating challenges. But at the same time, the overall economy still remained really strong in Q1. So we'll see what happens here as the year goes on.
Marshall, I think one of the things about the market that many often forget is that it is a vehicle that always reverts to the mean, right?
Yeah.
And I think one of the takeaways from this chart should be just that, right? You could draw a line from here to where we're at today, and
right.
Well, we're kind of reverting to the mean, right? I mean, we're supposed to see these drawbacks in order to see the recoveries in the future.
Mm-hmm. Yeah. So sometimes we just have to zoom out a little bit. So that's what I wanted to illustrate here. If we just zoom out on the S&P, if we get too focused on the current drawdown, you got to realize that the S&P has averaged 15% over the last 10 years. 15% going back to 19, as far back as you want to go, that is historically large for a 10-year return. This is overheated.
Yeah.
Starting the year, we had a lot of feedback that growth stocks were overvalued. Coming out of COVID, people had this pent up consumer demand, and so your retailers, your Targets, your Walmarts, your Costco's getting crushed right now because they had such good results coming out of the pandemic, because people had assets, they had money to spend, and we are a consumer driven economy. So it drove those stock prices up probably higher than they should have been. It's a pendulum. Sometimes the market gets too overheated and then it swings back and it sells off too much. You can see the arguments today, and some people are going, well, this market's oversold. This is a buying opportunity. But again, that depends on your own personal situation. It depends on your time horizons, and it depends on your plan, Casey. But to give you some perspective, stocks and bonds are both down. And I emphasize with this pain, most people that have a 60-40 portfolio, they have to realize, though, that same 60-40 portfolio from 2009 to 2021 is up still over 300%. So
Right.
It's been a good run. We got to realize we got to deal with some of the heat when we deal with the market.
Yeah, and very clear, I think, from this chart that you can't time that. Some will say, well, if it was overheated, and shouldn't we have done something about it? And well, you could have said right here that the market was overheated and lost out on another 50% in gains, right?
Yeah, absolutely.
We have to be very cautious with attempting to time anything in the market, and we can stay overheated for an extended period of time. We don't know if that period of time where we're going to see extremely high valuations is going to last a decade or it's going to last 12 months. And so again, we stay the course. We have a strategy, we have a plan, and we have the gumption to take advantage of opportunities like this when they do arise, with the dry powder that we keep on the sidelines.
Yeah, I just met with a family that I think they're on the call right now, but they've been waiting to deploy some capital until they saw a buying opportunity. And so they've been sitting on their hands for 12, 18 months. They sold some property and were ready to get that into the market. So looking for those buying opportunities, individuals, I had another conversation this morning before that where these individuals had gotten safe some time ago, and now they're going to start, dollar cost averaging back into the market with some of their safe dollars. So every situation is a little bit different. We want to try and take advantage of it. I think from an outlook perspective, it's really murky. We want to see what happens with inflation. Inflation could remain high depending on how things start to turn here. There are some indicators that give us some belief that we've already peaked on the inflation side, but these things are hard to know in the moment. We have to kind of see what the month over month figures begin to play out. But inflation could have peaked already, but it could still remain high. But spending is likely to slow down. The consumer was kind of flush
But
with
these are the
cash.
things that are getting priced in right now, Marshall. These are
Yeah.
the things that are getting priced in right now. The
Hmm.
market, remember, it's a forward-looking indicator. So these risks
Right.
are what are being priced into the market. Just go back, look at 2020. Why did it rebound so quickly? Because it was forward-looking at what was going to happen once we got out of shutdown, right? It's always looking forward, and that could be negative or it could be to the positive. Today, it's to the negative.
Yeah, well, and I hear that from families. I had a gentleman joke last night. He's like, "Listen, the market doubled in basically a year, and now I'm expecting you to coddle me for being down 15%." And he kind of joked that he knows it too, right? It's one of those things where nobody likes to see losses, right? I don't like to lose money more than anybody else, but at the same time we just have to have some perspective and decide, if we can't quite handle the volatility that we're seeing, there are other solutions. We just have to be kind of willing to explore those and try to understand that, hey, the market might be volatile, right? Going through the summer months tend to be a little bit more volatile because there's not a lot going on from a policy perspective. Congress goes on vacation. There's not a lot of big news that pops in the summer, like at the beginning of the year and the end of the year. So any sort of, black swan event or something that just flies out of nowhere is going to create that volatility. So don't be surprised if this is kind of a up down roller coaster sort of year leading into the midterms. I think that's a big target for a lot of individuals. They want to see what happens in the midterms and how the year finishes up. But just kind of be aware that volatility may be here with us for the while, because the Fed is starting to exit the market. Right, the Fed has been driving so much money into this market, and they're starting to exit the market. They're starting to tighten their balance sheet, and that is going to inherently create more volatility than what we saw coming out of the March 2020 lows.
And Marshall, you're encouraging us to get back to the basics, huh?
Yeah, you know what? Sometimes we just have to get back to the basics. We have to go back to the plan, reassess, try to understand where you're at and what's changed, right? There's no perfect plan, but we have to sometimes kind of go back to the plan just to understand what our expectations were. Most of the families that I've been working with for the last 5, 10, 15 years, if I go back and look at the original drafts of their plan, they are in significantly better shape than what we had conservatively projected. So we need to go back to that, and we need to have those conversations. Remember what your required rate of return is. Remember why we built the plan the way that we did. Let's address the liquidity, the income, the flexibility, and the growth, and make sure we understand how the estate plan has changed. There's never going to be a perfect plan, but we have to go back to that. But we have to be prepared for situations like that. That's why we prepared for the worst when we built a lot of the plans that we built, because the stock market volatility and losses affect us psychologically different than those gains do. I recently read a book by Jason Zweig, who has a book called Your Money in Your Brain. And he taught me that losses and gains have a profound physical effect on both the body and the brain. And financial losses are processed in the same area of the brain that responds to mortal danger. That's why these things feel so scary. It's the
Feels like I'm
same
getting
part.
chased by a tiger.
Yeah, and to be fair, the market is responding to the monster under the closet. I used to use this story when my son was younger. He was scared of the monster in the closet, and it's like, well, let's see what we're dealing with here. Let's open that closet up. Let's get the
What'd you
baseball
do,
bat.
Marshall? I,
I
I think
I
that's what
got
you
out.
did.
Yeah, I got a baseball bat out, and it's like, let's see what we're dealing with here. Let's get after him. And after he realized that it wasn't as bad as he thought, then things were back to normal. And that may be what happens here with the stock market. We tend to overreact, and there's a lot of selling pressure right now. But if the Fed orchestrates a soft landing and they get inflation under control and they don't have to raise rates quite as many times as they thought, we start to see some resolution to the conflict overseas. And like, heck, things may be in a much different place in 6, 8, 12 months. But go back to the basics, go back to your plan, and understand that things could get worse as well. I'm not trying to make everybody wear rose-colored glasses here. Things could get worse, right? If all those things that I just referred to don't happen, the Fed can't orchestrate a soft landing. Well, then it can obviously get worse. So it means that we just have to reassess, go back to the basics of your plan, and make sure it's still sound.
Yeah. And that's why we call our plans really a framework. It is a framework to help us make decisions as your emotions evolve, as the markets evolve, as the economy evolves, as your priorities evolve throughout life. We need a framework to make those decisions upon. And this is a good time to go back, revisit the plan, realize that you're still on track. Number two, take a look at your risk and understand that risk again. Maybe initially when you implemented your plan, you were a moderately aggressive investor, and now you experience a drawdown, you have some anxiety, and that helps you to realize maybe I'm not nearly as comfortable with risk as I once thought. Maybe it's time to evaluate alternatives. Maybe you have too much exposure to fixed income or bonds, and it's time to look into fixed income alternatives. Maybe you have some cash on the sidelines. Maybe part of our planning, we have our liquidity or income or flexibility or estate bucket. Maybe that liquidity bucket we overfunded. We have the opportunity to reallocate some funds to the market. Maybe you have some dollars in the income bucket that were set aside in a fixed income alternative, and you go, hey, this is a great opportunity to put some of that cash to work, move some of those funds out of those more conservative vehicles into equities over time. And we have tax management to do as well. So as part of our plan, tax planning runs throughout that entire strategy because it's something we have to constantly revisit as opportunities present themselves from a policy perspective or a market perspective. We did more Roth conversions in 2020 than we've ever done before in the history of our firm. We've been really focused and promoting Roth conversion since 2006, 2007. And this is something that we really need to revisit when we see major drawdowns in the market. The market pulls back. You have the opportunity to take that depressed value in the IRA, reallocate it, pay taxes today, move it to a Roth IRA, and then rebound into the future and experience all that tax-free growth. We've also been doing a lot of tax loss harvesting right now. And I have a gentleman I've worked with that he's incredibly aggressive, right? So we've seen a pretty significant drawdown in that portfolio year to date. And we said, hey, why don't we go ahead, we'll liquidate these positions today, take advantage of those losses, let them hit your tax return. That'll buffer any losses you may incur in this year. Or we may see a recovery by the end of the year, and then that just creates additional tax alpha, as we like to call it. And in the meantime, we'll take those dollars that just got liquidated, we'll reallocate them to a portfolio of assets that'll still benefit from that rebound, avoid the wash sale rule of 30 days, and then we can move those funds back into those positions. So there are things that we can do today. It just goes back to go back and revisit your strategy at the end of the day. So Marshall, if you don't have anything to add, we'll jump into Q&A.
No, let's do it.
Great. Well, we've got about 15 minutes for Q&A here. So if you have any questions, drop them into the Q&A right there on the bottom of your Zoom screen. Click on Q&A, drop the questions right in there, and we'll start getting to some of these. Before we actually get to the questions that were just dropped into the Q&A segment during our call here live, for our weekend reading subscribers, those of you that receive our weekly email every Friday, you signed up at retirewithpurpose.com. We reached out to you prior to this for you to submit questions prior to the call today, and we want to prioritize those of you that are subscribers. We have a question here that is quite lengthy, so I won't go through every bit of it. But Greg, thank you for your question and all the context that you offered. The question really had to do with inflation and the US dollar and how to stabilize those things. So to just jump directly to the question and not go through too much of the context, so we can make sure we get to these other questions. The question is this: as the value of each US dollar grows less with each additional new dollar printed, what can be done to stabilize our savings dollars in the face of impending growing inflation?
Yeah, that's a good question. I think it's something that's on the minds of lots of individuals when they see the Fed's balance sheet at a level that it hasn't been at since World War II, I believe. What I would say though is actually the dollar is kind of strengthening in the face of all that. And Casey, I think we were chatting about that
Yeah.
the
And
other day.
the dollar is stronger than it's been in decades, right? And it's like, well, the stronger dollar's actually the threat, not a weaker dollar is a threat right now to trade. And so we want to help. I think it's just being cautious of what you're consuming and really going back to actually looking at the facts. And the fact is that the dollar has been strengthening. It's stronger than it's been in decades, since 1987. And what's happening around the world? Why is that? I mean, in a large part, that is because we're not the only country in the world that printed money, right? But we're one of every reserve bank in the world has been printing, and it's that helps us continue to index and stay stable. When it comes to impending growing inflation, how do we stabilize our dollars in the face of growing inflation? We just go back to the basics again, right? What are those inflation protected assets? What are the assets that you can own that have outpaced inflation over the long run or have the best returns in an inflationary environment? And you're going to go back to number one, real estate. So do you own real estate? Number two, US equities, commodities exposure, Treasury inflation protection securities. I mean, there's a lot of options for us to continue to allocate to ensure that we're keeping up with inflation over the long haul. In the short term, we may feel that, well, we're not keeping up with inflation, but over the long term, as we saw in some of those charts, that's where we're headed.
Yeah, great point.
So the next question is from Jenny. Jenny asked about Treasury bonds, saying, are Treasury bonds good investment now? I heard they're paying 9%. Well, Treasury bonds?
So I think she might be referring to I bonds, right? There's a lot of discussion around I bonds. I bonds are issued by the Treasury, and so if you go out to treasurydirect.gov, you can learn more about I bonds. Basically, there's an inflation adjustment that occurs every 6 months, and so right now, as you can imagine, with inflation over 8%, they are paying a tremendous return. Now, it's kind of a pain in the rear to buy them. Actually, you have to set up an online account. The actual process is not terrible. I went through it with my parents. We should just interview them for this segment. How difficult it was, but you can only put so much money there, right? It's like $10,000 per individual. There are some workarounds, but for the most part, it's not a bad investment. I mean, it's a government issued bond that's paying a decent return, and heck, I don't think inflation's going to drop down to two or below percent for maybe a significant period of time. So it might not be a bad diversifier to your portfolio and some of your emergency funds.
$10,000 per Social Security number. I mean, you're going to be pretty limited in what you can allocate there, but depending on your net worth, it may make sense. Yeah, depending on the investable assets you have, it may make sense to allocate some dollars there. For some, it might be more of a headache than it's actually worth in the long run. Gerald asks, hi, thank you for hosting the webinar. You're welcome, Gerald. Thanks for joining us. I was planning on retiring.
Thanks for the question.
Yeah, I was planning on retiring at the end of this year. I'm 64. Should I wait until I'm 65 or 66?
Geez, I haven't seen this question, Casey, since 2008, 2009, somewhere in there. That was a time where individuals had to at least consider, do I want to retire at this moment? Obviously, it's a pretty personal question. It kind of depends on what your resources are, what your spending looks like, what additional sources of income, if you've got pension or if you're going to be turning on Social Security. But during that period of time, I did have to counsel individuals that the losses that they saw during those drawdowns did inherently ruin their plan. And that's why we preach so much about, those retirement red zone years. As you start to get 5 years out from retirement, we need to start to put some guardrails in place or start to put some buffers in place to make sure that you can have a soft landing into retirement. But I think you just have to run the math. A lot of individuals for the last few years, Casey, have been saying the opposite. Like, I thought I was going to work till 66, but hey, look at the 401k balance. Now I'm able to retire at 64, 63. So it's been, a tailwind for them the last couple of years, but now it's starting to the market's starting to become a headwind for those individuals that are nearing retirement or recently just stepped into retirement. But I will tell you, it's one of those levers that if you like your job and you don't mind what you do and you don't mind going an extra year or two, well, of course, that's only going to help your plan.
It's never bad to
of the
make money,
situation. Yeah.
right? It's never bad to make money. We should always keep making money, if we enjoy what we're doing or if we need to do it for that matter. But, for most, even with the drawdowns we've seen year to date, you're still
Right.
sitting in a much better position than you were a couple of years ago. And so we want to take that into consideration. You've got Medicare age free coming up at 65. You have Social Security increases to take into consideration. And there's a lot to consider. And that's just, Gerald, that's going to be a question best answered in a one-on-one situation, sitting down, getting a consultation with our team, and really getting a personalized answer there at the end of the day. Thomas, hey, thanks for dropping us a line here. Thomas asked, I jumped on my company 401k at the end of March to focus on debt reduction. I have the opportunity to get back in July 1st. Does it make sense to stay on the sidelines for the balance of the year, or am I better off jumping back in at the bottom, hopefully in all caps?
So the bottom may actually occur before then, but you never really know. But this is a wonderful time to invest, right? We want to buy things that are on sale. Why is the stock market the only store in the mall where the prices go on sale? We're down 20%. We got a 20% off sale, and everybody runs out of the store, right? This is a buying opportunity, but it depends on your time horizon, right? If you're 75 and retired, it might be a little bit different. But if you've still got time, or these aren't dollars that you're going to utilize for 10, 20 years. And remember, some people will go, wait a minute, I need some of this money in 6 years when I retire. Yeah, sure, but you don't need all of it, right? We need to segment our time with our dollars. Not everything needs to get conservative when somebody retires. We need to segment out those pieces of your portfolio that you need in those first 5, 10 years. Use a segmentation approach, but things that you're not going to use for 10 or 20 years. For some of my clients, they may never spend this bucket over here. This may be for the kids. Well, look at their ages as the time horizon, right? If your kids are 27 years old, then heck, that portfolio can be 100% equities over there because based upon their ages. So I think it's a wonderful time to increase 401k contributions. Make sure you're getting at least the match. Sometimes we encourage individuals to change their investment allocations. Maybe you can have your current dollars in the plan invested a little bit more conservatively if you're getting ready to retire, but have your new money going into the S&P, have your new money going into the fire, so to speak. It's just like those coal engines where you're shoveling coal into the engine there. That's what you're doing every paycheck is pushing that train further on down the tracks.
Yeah, and it depends on the debt situation. I think for most, it's not going to make a whole lot of sense to focus on debt reduction rather than investing if this is older debt. I know for myself, I'm not going to pay down any more of my debt than I need to. I'm going to allocate more dollars to the market rather than paying down that debt, because that debt is anywhere from 2.5% to 3.5% from an interest rate perspective. So
Yeah.
I'm not going to be, attacking that 2.5%, 3% debt with vigor when I have the opportunity to buy into a depressed market that has historically averaged 7-10% a year.
Well, and I kind of read the question differently. I kind of read it like, okay, I had some short-term debt, or I had some credit card debt, or I wanted to pay off a
Sure.
home equity line of credit. So it sounded to me like he's paid off the debt and now wants to know whether he should continue to take home more from his paycheck or to invest that. And I would say absolutely invest it. Reed, I was standing next to Reed yesterday when he got a phone call from a client who was doing the same thing, and she wanted to stop contributing to her 401k. She said, well, I think it's better off sitting in the bank, earning nothing than losing. And I said, that's the exact mentality that we want to have. We want to be fearful when others are greedy, but greedy when others are fearful. So invest even more when the markets are scary.
Yeah, and Tom, if you're already working with someone else, we'd be happy to take a second look at that plan for you and see if we can add some value. We'll share with you just how to do that here in just a minute. We got a couple minutes before we need to wrap up here. Now let's jump down to a question here from Anonymous. So Anonymous says, soon we'll be meeting with our Howard Bailey advisor for our review. We pulled out of bonds last year. We're in some tips right now, but we've still lost. So we've still had downside on the market side of our portfolio. And anything we can concentrate on at this point to mitigate further downturns or capitalize on expected market turnaround?
Sound like conflicting goals, don't they?
How do we mitigate further risk to the downside or capitalize on market turnaround? Right. I think not necessarily conflicting goals, but kind of a double-edged sword, right? It's like, I don't want to lose anymore, but I also want to take advantage of the opportunity on the other side.
Yeah, I think you have to get real clear on what the objective really is. Is the objective mitigating downturns, or is the objective capitalizing on expected turnarounds? Anytime we're doing Roth conversions, I think it's a wonderful opportunity for the next several years while some of the Tax Cuts and Jobs Act tax breaks are still around. We got through tax year 2025 for most of those tax breaks. So I do think it's a great time. Tips, unfortunately, are normally a decent inflation hedge. They haven't performed all that excitingly well so far through this scenario. But yeah, on the market side, trying to understand if you're doing Roth conversions, well, hopefully that's money that you're not going to be spending for 10, 20, 25 years, and maybe that's money that's going to be left to the kids. So I would encourage those things to still be very growth oriented. I'm not trying to mitigate risk for any of my clients on their Roth dollars. Roth dollars are typically going to be the more growth-oriented pieces of the puzzle, because the more growth you get with those, the more tax-free benefit you're going to see at the end of the day.
Yeah. We have time, it looks like, for maybe one more question here. Anonymous says, I am planning Roth conversions over the next 10 years. I am taking my MAGI, my modified adjusted gross income, to the top of the 24% tax bracket until I am 63. Then I'm taking my income to the top of the first IRMA limit, income-related monthly adjustment amounts that pertains to your Medicare. And how do you all evaluate the tax and IRMA brackets? The escalations are not defined in the IRS code, best I can tell. So, Marshall, go ahead.
I don't know if I understand the question entirely.
Well, let me get started. And that is, how do we evaluate, in-house doing Roth conversions in order to hit those upper tax bracket limits and the IRMA brackets? Well, we will leverage internal software in order to stress test future tax rates to where we're at today and see what the long-term value is, and weigh that with the short-term cost of doing a Roth conversion. And that part's fairly simple, taking a look at tax brackets and leveraging software in order to determine where we're going to land. And often we want to spread those things out to a certain degree, because you may not know exactly where you're going to land tax-wise until the very end of the year. And we're no longer allowed to recharacterize those Roth conversions. So while we used to maybe do a lump sum conversion at the beginning of the year, now we tend to spread those out a little bit more, maybe dollar cost average, do them quarterly, barbell. There's a lot of different approaches there. When it comes to IRMA, those things aren't defined by the IRS. They are defined by Medicare. And so we can look at those IRMA brackets specifically to try to avoid those. But at that those penalties. But there is a lot more to think about when you get to Medicare age and when you're on Social Security, when you're doing Roth conversions, because doing the conversion could make more of your Social Security become taxable, could also cause Medicare premium penalties. So we need to take those two things into consideration, not just, hey, what's my current tax bracket and what are taxes going to look like in the future for me?
Mm-hmm.
Awesome. Well, hey, we have a few more questions here and we'd love to get to all of those. We will get answers back. We're committing to getting answers back to each and every one of you. A lot of these questions, I will say, we have addressed in our podcast. So, I would encourage you to check out the podcast. Check out the podcast to answer the majority of the questions that you might have and just go a little bit deeper into some of these different topics, yield curve inversion, et cetera. We did a whole episode, talked about 25 minutes on yield curve inversion. That was one of our questions. We've done many extensive discussions around Roth conversions, et cetera. And if you're ready to schedule a discussion with your advisor, or maybe you're not currently working with an advisor, this is a great start for you. Just go to howardbailey.com/meet, and then you can scroll down, you can select your advisor from that list, go directly to their calendar to schedule a call to discuss anything that maybe came up for you throughout this conversation. And for those of you that have not been working with the Howard Bailey team, you just click on the link right there. You can use the same link, but then click on the box that says, I don't have a Howard Bailey advisor, and that'll take you directly to an advisor's calendar so that you can get on and start moving on your way towards a job optional life, or maybe one that's just elevated that much more. So thanks for joining us here. It was a pleasure to share our thoughts and answer some of your questions. Look forward to seeing you in a couple months.